Welcome everyone to our channel Zreya Wealth. In this series about behavioral finance, we are discussing about the different biases which affecting investor decisions. And today we are going to discuss about anchoring bias. And this, of course, I think this is a big daddy of all biases. So let's understand from Venkatesh what anchoring bias is. So Venkatesh, what is this anchoring bias?
See, basically anchoring bias is, to put it in simple terms, anchoring bias is something where you just rely on your first-hand information, okay? What you listen first, you just stick on with that and you put an anchor over there, okay? And you won't do any specific research or analysis on the facts and other relevant information, and you make your decisions. So this anchoring bias is applicable in our day-to-day business and as well as in our investment journey as such. So day-to-day investment, to put a simple example of how anchoring bias works, all of us would have done this, street shopping, right? When we do a bargain shopping. So how does that work? On your experience, how does a bargaining purchase works? You walk through that street and you find something interesting to you and you start negotiating, right? So how the negotiation process works on your experience?
No, I'm not a good bargainer, Venkatesh.
Basically, the how it works is like the shopkeeper, okay? He will fix a price, right? Okay. So it might be a product worth of, let's say, 10 rupees. The anchoring effect, how this salesperson is going to do is like, initially he will set a price of 30 rupees. For the product value, what is the product value? It's just 10 rupees. Okay. The anchoring effect, how it happens is like the shopkeeper says, once you start bargaining, it starts with 30. So what the shopkeeper has done over here is like he has put an anchor over there on your mindset. Okay. So the product is 30 is a bit expensive, but if you can bargain it to a much more lower level, then you want the deal. So you start negotiating with the shopkeeper and you say, I will give 20 rupees. Okay. And again, that is how the basic bargaining works, right? And shopkeepers say, I will give it for 25.
So based on the initial anchor, I will go maybe plus or minus 5, not beyond that, right?
Not beyond that, because the actual price, you are not taking that into account, right? Your mind or your brain is not allowing you to look at the worth of that particular real value. You are not doing analysis over here. If you do that analysis, then you will say 10 rupees and shopkeeper will say, no, I am not going to sell this. You just keep going, right? So normally how it happens is like you again negotiate, you negotiate for 20 rupees and shopkeeper says 25. Then you personally feel that you had made a good gain of 5 rupees. But in effect, if you look at the value of that particular product is not more than 10 rupees. So the anchor price is something which the shopkeeper has put upfront and you stick to that price and your entire negotiation revolves around whatever the price the shopkeeper has told you upfront. You are not putting in your facts, you are not putting in your thought process whether this particular price is the right value or not. This is what happens in a very simplistic way. The same thing happens in investment world as well. Okay.
For example, so here in investment world, it's not just about pricing, right? It's about getting stuck to one asset class.
It is getting stuck to one asset class and it is also getting stuck to a particular concept or particular idea or particular company for that matter. Okay. To quote an example for that, the recent startup IPO listing which has happened. Okay. If you look at in pre-IPO market, most of these pricing was going on a premium. Okay, so the anchor effect, what happens is like the pre-IPO sellers of this particular securities have given an impression that on IPO date, this is gonna get listed at a premium. But what has happened is like it has got a completely reverse effect. So the anchoring price is something which from the pre-IPO market, what we have got is something which has put as an anchor. This happens in the entire financial investment decision assets, because what happens over here is like beyond the first information that you have got, that you stick with that. You put an anchor over there and you are not thinking much or you are not doing a basic analysis on whether it is a right value price which has been put over here. Is this a justifiable price? You are not looking at it. Just because of that particular bias, you just go and buy. And many times this will have a very negative impact on the long term. So this is something which you need to by practice, understand and take time. All these aspects of behavioral finance is something which you cannot get an expert in a day or two. It is something which you need to take it as a practice. You need to understand, you need to give some time to learn the basic concept of this and apply your thought process accordingly to ensure that you are not falling into any of these biases. Anchoring bias is one of the very common biases in which investors fall prey for. And again, as you told, a particular investment asset class also, if that is what is your first-hand information is, this is going to be one of the best asset class in place which can give you more returns, you will stick only with that. To quote an example for that, the cryptocurrency market, which we had seen a lot of euphoria in that, a lot of people without understanding what blockchain is all about, how cryptocurrency market works, but still with the first-hand information what they have got is like crypto is one of the high return yielding investment option. Let me just go and invest in that. Many people without understanding how the process works, how the investment works, has lost their money, a lot of money in that. So this is how the anchoring effect works. Anchoring effect will have a domino effect on other biases as well. Once you stick into that particular anchor, this particular investment is best, and other biases also will get joined, and it will what you sum up as a total disaster financial decision that people make. So this anchoring bias is throughout in our day-to-day business also we can see, as I quoted as an example of how a street vendor sells his product. There also an anchoring effect is there. So how you need to come out of this anchoring effect, or how not to fall prey for this anchoring effect, is to, before making any impulsive purchase decision, you need to apply some thought. You need to find out whether this price or whatever value that has been offered is right or wrong, using your analytical skills or using logic. Okay, at least fundamentally or technically you need to clearly understand whether the value that has been quoted is right value or not. So once you start applying thought on that process, you need to do some backdated research on whether this is the right way of doing it in that particular product or any similar product to that, or in that particular company or any similar company in the space in which it works, how it has performed, or what all the things that has happened. You need to do some basic analysis, basic research, so that you can prevent yourself from falling into this particular biases trap.
Is it related to confirmation bias, like as such, where I'm anchored to one particular thought, so I keep on trying to find related information which only confirms this? I don't think beyond this anchor.
See, yes, it's more or less similar if you look at anchor bias and confirmation. As I told you, all these behavioral finance biases are more or less interconnected. So anchor bias is something which the first hand information what you get, with that you are getting stuck. Okay, and beyond that, other biases can also follow this and take you to a much more very bad shape on the investment decision that you had made. That is how it works.
So I continue to believe that rather than analyzing the information.
Yes, they just believe, and believe in the sense the first hand information what they have got. The first time, once you get an information, you are putting an anchor over there. So there it stops. You are not, post that, you are not going to make any specific research or any specific analysis on that particular information. You just trust that information and go ahead, and that might get you into trouble.
But is it not like that first impression is the best impression? Is it like something against that?
See, first impression is best impression is something which might work in a different parlance if you look at. So information, once you do an analysis, then you will come to know whether the first information has been the best information or good information or not.
Okay. So thanks for that valuable information on anchoring bias, Venkatesh. I hope it was very useful to our investors and viewers. So thank you everyone for viewing this video. I hope it was useful for you. So please do share your comment section below, and also like, share and subscribe our channel. Thank you.